We've got an interesting couple of days ahead of us with the US jobs report on Friday being the natural highlight. And what's made it even more interesting is the JOLTS job openings from the US yesterday. They were much lower than anticipated and pointed to potential slack appearing in the labour market. The first area where that was going to appear was going to be from lesser hiring intentions. We've already seen as well mass layoffs being announced in the tech space and also in banks, but also a few other companies as well, announcing that they are laying off large numbers of staff. And therefore, we are now starting to see potentially signs of a weaker labour market in the US. The reason why that's so important is because we have seen inflation generally trending lower. But one massive obstacle to the Fed ending its tightening program has been that continued tightness in the labour market, a red-hot labour market up until now, which is leading to strength in the economy and removing the potential for wage pressures to move back to a more sustainable level. The JOLTS data suggests that we are starting to move in that direction. So that puts extra emphasis on that jobs report on Friday. A weaker jobs report, especially given the red-hot jobs report we had in January and the decent jobs report we had in February, if we can see a weaker jobs report on top of that JOLTS number, that may give the Fed a little bit of confidence that the end of the tightening cycle is either near or here, depending on how tight credit conditions have come in the banking sector against the backdrop of what happened over the course of the last month. So that's going to be a key focus for traders going into the end of the week now. And speaking of central banks, there's been one of the less talked about central banks that made the decision overnight, and that's attracted a lot of attention today. The Reserve Bank of New Zealand raised interest rates by 50 basis points again, taking the OCR to 4.75%. A very hawkish rate hike, especially against the backdrop of a market expecting 25 basis points, and that was widely expected as well. So a real big surprise to the upside here from New Zealand, pointing to the tightness in the labour market, a familiar story, but they've got their own issues driving that tightness in the labour market, some of which relates to the restrictions that were imposed over the course of the last few years in relation to the pandemic, creating that additional tightness in the labour market that we are seeing there now, and the higher inflationary pressures. So they think they're going to have to do a lot more. Markets are now pricing in another 75 basis points of tightening from the RBNZ over the course of the next few meetings before interest rates then start to fall later this year, because there's a strong chance now that that takes a heavy toll on the economy. So New Zealand is one of the countries where we're strongly expecting a recession to appear at some point this year, which will lead to those interest rate cuts. So central banks clearly around the world aren't quite done yet. Some are sending that message that they are. The RBA, for example, earlier this week, indicating that they may well be done, but there is the potential for further rate hikes down the road. The Fed, the Bank of England, and others seem to be extremely close, if not already there. The RBNZ certainly not in that frame at this point in time. And given the two things we've been talking about, it seems natural to talk now about the Kiwi dollar versus the US dollar. So here's a daily chart, and it has been quite interesting here because we have seen the Kiwi dollar rising against the US dollar for a number of weeks now. Now, that's probably been primarily US dollar driven, but the fact that the RBNZ remains very hawkish and more hawkish than the markets were expecting will be helping that along too. For you can see from a technical perspective that we are testing the 55-89 day simple moving average from below. We did break above here earlier on today. That's the purple moving averages. We broke above here earlier today, but it has retraced back off the upper part of that descending channel that we've been consolidating in now for the majority really of 2023 so far, to trade now below that 55-89 day simple moving average. There doesn't seem to be an enormous loss of momentum at this stage, which I think is interesting, which suggests to me that we may potentially see another run at that descending channel top. But at this point in time, it is now trading back below the 55-89 day simple moving average. That said, it has broken back above the 200-233 day simple moving average. That's the two red moving averages that you can see on the chart there. As far as the Fibonacci retracement level is concerned, that's another interesting point here, because if we are going to see a rally in this pair, the fact that we've retraced off of that or close to that 50 fib does suggest that this is a corrective move. Of course, we are seeing a lot of ifs, buts, and maybes at this point, because we are seeing a lot of moving parts, and of course, the dollar is the dominant driver with regards to this currency pair as well as many others. But it does seem that we are potentially setting up for a bullish move here. The one thing that potentially offsets that is the green Fibonacci retracement that you can see on there. That's the longer term. It actually goes back to the highs of February 2021. And the thing that makes me cautious is that we've already rotated off that 50 fib, the longer term 50 fib. So that's looking like a potentially big area of resistance, as it was back in December and again in January, and then late January again. We saw it run into strong resistance around 0.65. And therefore, that looks like still a significant barrier to the upside. So while a move above the descending channel may potentially be a bullish signal here, until it breaks that 65, 66 level, breaking through those prior resistance and through that 50 fib on the longer term time frame, it's hard to become particularly bullish about this pair. Of course, we could just see further consolidation, but it's interesting that we have seen a strong rotation just today off of the upper end of that descending channel. So I think this is certainly one to watch, especially when we've got one very hawkish central bank coming up against another central bank that may be done with a tightening cycle. The US jobs report on Friday is going to be pivotal to this. A weaker jobs report could see that final rate hike being priced out of the market and maybe even additional rate cut priced in for the Federal Reserve later on this year, potentially dampening sentiment towards the US dollar and potentially being the catalyst for a breakout, a significant big breakout in the Kiwi dollar pair.